Hey everyone, welcome back to Corporate Decoder, the place where we reveal how the corporate world plays with its numbers. Today, we're diving into Verastem Incorporated's latest filing. And let's just say they're cooking up something interesting in the public markets. So, what is the big story here? Verastem Incorporated is announcing a significant stock offering. They are selling a whole bunch of their common stock and some special pre-funded warrants. Think of it as them raising a substantial amount of money to fuel their future operations and growth. In simple terms, Verastem is looking to bring in a significant chunk of cash. They are offering shares of their common stock, which are basically tiny pieces of ownership in the company. They're also offering what they call pre-funded warrants. Now, these are a bit like options to buy stock later. But here, they're structured so that investors can essentially buy shares now at a slight discount compared to buying them directly. It is a way for the company to secure funding while giving investors a slightly different way to participate. The key document detailing all this is the underwriting agreement. This is the contract between Verastem and the investment banks, like Jefferies LLC and Guggenheim Securities, LLC, who are helping them sell these shares to the public. These banks acting as underwriters. Buy the shares from the company and then resell them to investors. They take on the risk for a fee, of course. Now, let's talk numbers. Verastem is selling a base amount of 8,543,794 shares, called firm shares. On top of that, they've given the underwriters an option to buy even more shares if they see strong demand. This is like having a backup plan to sell more if people really want in. And good news for Verastem, the underwriters decided to exercise that option in full, meaning they'll be buying even more shares. This option really boosts the total number of shares being sold. It shows the underwriters are confident there is appetite for more of Verastem's stock. It is a signal of market confidence in the company's offering. The price for each share is set at $7.25. For the pre-funded warrants, the price is just under that at $7.2499, reflecting a very small exercise price. This means investors are essentially paying almost the full share price to get these warrants now. So, what is the grand total they expect to bring in? After all the fees and expenses are paid, Verastem is looking at approximately $96.9 million in net proceeds from this offering. That is a substantial amount of capital to deploy for business growth. To put it simply, they're raising nearly $100 million. This whole offering is being done under a previously filed shelf registration statement. Think of this as a pre-approved menu of offerings the company can tap into when market conditions are right. It allows them to act relatively quickly when they decide to raise money, as they've done here. The fact that it was declared effective back in November 2023 means they had this plan in motion for a while, waiting for the opportune moment. The whole deal is expected to wrap up around the 17th of November, 2025. This is the closing date when the company will officially receive the funds and the shares will be delivered to the investors. Now, let's talk about those pre-funded warrants and a really interesting condition tied to them. They have a limitation on how many shares a single investor can beneficially own if they exercise these warrants. This is a common tactic to prevent any single investor from accumulating a controlling stake in the company too quickly through these warrants, especially if their existing holdings are already significant. It protects the company from unwanted takeovers or shifts in control right after the offering. Another key feature of these pre-funded warrants is what happens during an acquisition. If Verastem gets bought out, these warrants automatically convert. Holders will receive whatever the acquiring company is paying for its shares, essentially meaning these warrants will be cashed out or converted into the acquiring company's stock at that point. Without being hindered by the ownership limits, it ensures that warrant holders get a fair shake when the company is acquired. The underwriting agreement itself is a pretty standard, albeit complex, legal document. It outlines all the promises Verastem is making to the underwriters and what conditions must be met for the deal to go through. It also includes protections for both sides, like indemnification, meaning if something goes wrong legally, one party might compensate the other. And as with any major financial move like this outside legal counsel, Ropes and Gray LLP in this case has issued an opinion. This is essentially a legal confirmation that everything is in order from their perspective regarding the shares and warrants being sold. It's a stamp of approval from their legal experts. Looking at the exhibits filed with this report, we can see the actual underwriting agreement under Exhibit 1.1, the form of pre-funded warrant under Exhibit 4.1, and the legal opinion under Exhibit 5.1. These are the detailed documents that back up everything we've discussed. Now, let's step back and look at the bigger picture here. Verastem is clearly in a phase where they believe raising capital is crucial for their growth strategy. This significant injection of cash will likely go into funding research and development, expanding their commercial efforts, or perhaps even making strategic acquisitions. The fact that they secured a strong commitment from underwriters for a substantial amount, and that the underwriters exercised their option for additional shares, suggests positive sentiment from institutional investors about Verastem's prospects. However, we always have to look beyond the immediate fundraising. The key questions become how effectively this capital will be deployed and what the long-term returns will be for shareholders. Are they investing in promising pipeline assets? Is their market strategy sound? The success of this offering hinges on Verastem's ability to translate this newfound capital into tangible business progress and ultimately profitability. A notable risk with stock offerings, especially for smaller companies, is dilution. When more shares are issued, each existing share represents a smaller percentage of ownership. While this offering is a necessary evil for growth, it is a factor investors always need to consider. The management team's track record in capital allocation will be a critical determinant of whether this move proves to be a home run or a missed opportunity. In conclusion, Verastem is making a bold move to finance its future growth. They're raising a significant amount of money, signaling confidence in their business plan from the market's gatekeepers. The success of this strategy will depend on wise investment of these funds and delivering on their promises. It's an exciting time for the company, but one that demands close observation of their execution. Alright, that is our breakdown of Verastem's latest filing. What is your take on this stock offering and what it means for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives into corporate filings. Don't forget to check out our Discord community linked in the description. Thanks for watching. See you next time.